The next recession isn't just a possibility, it's a ticking clock. And when it hits, not all U.S. states will feel the blow equally. Some are walking into this storm more exposed than others. Today, we're counting down the 10 states most vulnerable to the next big economic downturn. This isn't about fear-mongering, it's about facts, data, and seeing the warning signs before it's too late. And before we get started, don't forget to subscribe, like, and hit the notification bell so you never miss out on more engaging content. Number 10. Kansas. Kansas may not dominate national headlines, but its economy is hanging by a thread. According to AP News, the Ogallala Aquifer, which irrigates one-third of America's crops, is being rapidly depleted, posing a severe risk to Kansas's agricultural backbone. The state's agricultural sector contributes over $65 billion annually to its economy, and without water, that lifeline collapses. You'd be surprised how much Kansas depends on farming. Agriculture employs nearly 13% of the state's workforce. AP News warns, experts in Kansas are warning that over-extraction from the Ogallala Aquifer poses a severe risk to the state's economy and the U.S. food supply. Without water, wheat, corn, and cattle production would plummet, sending shockwaves through the local economy. If a recession strikes while Kansas grapples with environmental collapse, rural communities could face mass job losses, bankruptcies, and population decline. Small towns already struggling with declining populations, Kansas has seen net outmigration for years, would be pushed over the edge. Businesses depending on farm income would shutter, further eroding the tax base. Complicating matters, Kansas ranks 35th in U.S. median household income, meaning families have fewer financial buffers to survive an economic shock. As tax revenues dry up, state services would be gutted, deepening the crisis. Add it all together, and Kansas is a disaster waiting to happen. Without urgent water conservation and economic diversification, Kansas risks facing both an environmental and economic collapse. If the national economy crashes, Kansas won't just struggle, it could break. Number 9. New Jersey. New Jersey looks wealthy on the surface, but its financial foundation is shaky. According to Wikipedia, the state's pension funds are projected to become insolvent within the next decade, creating a ticking fiscal time bomb. New Jersey already carries one of the nation's highest debt loads, with over $200 billion in total liabilities. The quote says it all. New calculations troubling for New Jersey pension system. Troy Singleton, government site. Pension costs are devouring nearly 15% of New Jersey's budget, leaving little room for services or emergency reserves. As tax revenues drop during a downturn, the pressure on pensions will skyrocket. New Jersey's economy is heavily reliant on sectors like finance and real estate, both vulnerable in a crash. Already, the state's median property tax bill is a staggering $9,500, the highest in the U.S., and residents are fleeing at one of the fastest rates in the country, shrinking the tax base even further. When a recession hits, New Jersey will be forced to choose between slashing services, raising taxes, or watching its fiscal health implode. Infrastructure, schools, and healthcare would all be on the chopping block. Without reform, the state risks becoming a cautionary tale of fiscal collapse. The bottom line, New Jersey's house of cards is trembling. A national downturn may be all it takes to bring it crashing down. Before we uncover the next country, hit that subscribe button, like, and hit the notification bell. It's your ticket to the stories no one else dares to tell. The more you support, the more truths we expose. Join us. Let's dig deeper together. Number 8. Illinois. Illinois is living on borrowed time. According to Wikipedia, it ranks among the top 3 states economically burdened by unfunded pension liabilities, alongside New Jersey and Kentucky. Illinois owes over $140 billion in pensions, one of the worst shortfalls in the nation. Wikipedia notes, Illinois, Kentucky, and New Jersey are the states most economically burdened by their unfunded liabilities. This crisis consumes nearly 20% of the state budget, limiting funds for schools, roads, and healthcare. Illinois has the second highest property tax rates in the U.S., and residents are fleeing. The state lost over 100,000 people between 2020 and 2022. If the economy tanks, tax revenues will dry up, pension payouts will strain resources, and public services will collapse. Illinois' manufacturing sector, which employs nearly 10% of its workforce, would be hit hard, sending ripple effects through the Midwest. The state's AA credit rating is already among the worst for U.S. states, making borrowing during a crisis more expensive. Population decline compounds the problem. With fewer taxpayers, the burden on those who remain increases, creating a vicious cycle of rising taxes and falling services. Illinois risks becoming trapped in a fiscal death spiral. Without structural reform, Illinois stands to become one of the first dominoes to fall if the national economy crashes. The warning signs are flashing red. Number 7. California. California may be the world's fifth largest economy, but beneath the surface, it's on shaky ground. According to Wikipedia, climate change is hitting the state hard, driving up insurance premiums, energy costs, and food prices. The result? A perfect storm of financial pressure on households and businesses alike. The report states, economic impacts also include inflation from rising insurance premiums, energy costs, and food prices. California's wildfire and drought disasters have already forced insurance companies to pull out, sending homeowners scrambling for coverage. Add in the nation's highest poverty rate, when adjusted for cost of living, and millions of Californians are already stretched to the breaking point. A national recession would hammer California's economy, hitting sectors like tech, entertainment, and agriculture all at once. Silicon Valley layoffs have surged over the past 2 years, with more than 300,000 tech jobs slashed nationwide, many of them in California. The housing crisis only worsens the strain, with median home prices topping $800,000 and rents among the highest in the country. California also faces mounting state debt, exceeding $500 billion in liabilities, including pensions and retiree health benefits. This fiscal drag limits the state's ability to respond in a downturn. As revenues collapse, the Golden State could face budget cuts, service rollbacks, and deep economic pain. Without bold climate and fiscal action, California's glittering economy risks buckling under a combination of environmental and economic threats. If the U.S. economy crashes, California won't be immune. It could be one of the hardest hit. Number 6. Texas. Texas has long been seen as an economic powerhouse, but its foundation is more fragile than many realize. According to the Houston Chronicle, Texas faces a double whammy: falling oil prices and shrinking energy investments, making it highly vulnerable in a recession. Oil and gas account for nearly 15% of Texas's GDP, meaning global shocks hit home fast. The Chronicle reports, experts foresee prolonged economic stagnation and advise individuals to reduce debt, conserve savings, and evaluate job stability. The Texas economy added over 650,000 jobs between 2021 and 2023, but many are in energy-dependent regions, where downturns could trigger mass layoffs. Housing pressures are another looming risk. Texas's rapid growth has fueled a housing boom, but soaring property taxes and rising mortgage rates are straining homeowners. Median home prices in major Texas cities have surged nearly 40% since 2020, creating affordability challenges. Compounding this, Texas has one of the highest uninsured rates in the country, nearly 18%, leaving millions exposed to healthcare shocks during a downturn. Infrastructure weaknesses, from an overstressed power grid to underfunded public services, further magnify recession risks. As oil revenues fall, state tax collections will plunge, threatening education, transportation, and healthcare funding. Texas may boast a tough image, but in an economic crash, its vulnerabilities will be hard to ignore. Number 5. Nevada. Nevada's glittering tourism economy may look bulletproof, but it's shockingly exposed in a downturn. According to the Washington Post, Senator Jackie Rosen has raised alarms over the sharp decline in international tourism to the U.S., warning of its economic impact on Nevada. The state's dependence on hospitality and gaming makes it uniquely vulnerable if the economy crashes. The Post reports, Senator Jackie Rosen, D. Nevada, is expressing concern over the significant decline in international tourism to the U.S., particularly its economic impact on Nevada. Tourism accounts for roughly 25% of Nevada's GDP, with Las Vegas alone drawing over 40 million visitors annually. But when global travel slows, hotels, casinos, and restaurants face layoffs and closures. Already, Nevada's unemployment rate hovers above the national average at around 5.4%, and in past recessions, it has soared into double digits. During the 2008 crash, Nevada experienced the nation's highest foreclosure rate and one of the steepest job losses. History shows this state suffers first and hardest. Nevada's housing market, once the epicenter of the housing bubble, remains volatile. Median home prices in Las Vegas have surged nearly 50% since 2019, pricing out locals and creating a bubble that could burst in a downturn. Meanwhile, the state's rainy day fund covers just a fraction of its annual budget, leaving little cushion. Without efforts to diversify its economy, Nevada risks repeating past collapses. If the global economy falters, the Silver State could face another harsh economic reckoning. Number 4. South Carolina. South Carolina's charm masks a fragile economy that's poorly prepared for crisis. According to Investopedia, the state ranks among the most vulnerable in the U.S. due to limited government reserves, weak social safety nets, and over-reliance on a few industries. The combination makes South Carolina an economic powder keg. Investopedia notes, southern and mountain states, particularly Louisiana, Colorado, Mississippi, and South Carolina, are among the most vulnerable. Manufacturing and tourism anchor much of South Carolina's economy, but both sectors crumble in a recession. Nearly 18% of South Carolina's workforce is in manufacturing, making it one of the most manufacturing-dependent states. The state's median household income hovers around $60,000 below the national average, and poverty affects nearly 15% of residents. Without strong safety nets, many families have little to fall back on during hard times. Housing costs have risen sharply, squeezing budgets and raising foreclosure risks. South Carolina's rainy day fund is thin, covering only about 6% of its general fund expenditures. In a recession, that's nowhere near enough to prevent deep cuts to education, healthcare, and public safety. Job losses in factories and tourism hubs like Charleston and Myrtle Beach would ripple across the state. If the national economy contracts, South Carolina's lack of resilience could turn a slowdown into a full-scale crisis, hitting working families and small businesses the hardest. Number 3. Mississippi. Mississippi is one of the most economically fragile states in the nation. According to Investopedia, it ranks high on the vulnerability list due to elevated unemployment rates and minimal government reserves. With nearly 19% of residents living below the poverty line, the highest rate in the U.S., Mississippi is ill-equipped for a financial shock. Investopedia reports, southern and mountain states, particularly Louisiana, Colorado, Mississippi, and South Carolina, are among the most vulnerable. Mississippi's economy relies heavily on agriculture and manufacturing, sectors that are highly sensitive to downturns. When demand dries up, workers in these industries are often the first to face layoffs. The state's unemployment rate hovers around 5%, already above the national average, and its median household income is just under $50,000, among the lowest in the country. Mississippi's rainy day fund is also underwhelming, with just a few $100 million in reserves, barely enough to cover essential services during a downturn. Housing insecurity adds another layer of risk. Homeownership rates are high, but many residents lack the resources to withstand a prolonged economic hit. Without robust safety nets, even a mild recession could push thousands into poverty and overwhelm state services. If the national economy crashes, Mississippi's lack of resilience could trigger a local disaster, with long-lasting consequences for families, businesses, and communities. Number 2. Colorado. Colorado's once booming economy has been showing cracks. According to Morningstar, the state faces rising layoffs, persistent inflation, and a worsening housing crisis. While the tech and outdoor recreation sectors have driven growth, they're also vulnerable to economic swings. Morningstar reports economic activity slowed, with increased layoffs, persistent inflation, and subdued housing production amplifying the area's long-standing affordability crisis. Colorado's unemployment rate has crept up to around 4%, and housing costs have skyrocketed, with Denver's median home price topping $650,000, far beyond national averages. The state's population growth has strained infrastructure, housing, and public services, leaving many residents priced out. Rent increases have hit nearly 10% year over year, forcing families to stretch thin budgets even further. When a recession hits, layoffs in industries like tech, tourism, and energy could deepen the pain. Colorado's rainy day fund is limited, and its dependence on volatile sectors makes recovery challenging. Inflation has already eroded purchasing power, and a national downturn would compound the problem, especially for renters and low-income households. Without stronger protections and more economic diversification, Colorado risks sliding from slowdown to full-scale collapse if the U.S. economy takes a nosedive. Number 1. Louisiana. Louisiana tops the list as the state most at risk of collapse if the U.S. economy crashes. According to Investopedia, Louisiana is burdened by high unemployment, minimal government reserves, weak safety nets, and unaffordable housing, a combination that leaves it extremely vulnerable. Currently, the state's unemployment rate hovers around 4.5%, and poverty affects nearly 20% of its residents. The report highlights Louisiana stands out as the least prepared, burdened by high unemployment, minimal government reserves, inadequate social safety nets, and unaffordable housing. The state's heavy reliance on industries like oil, gas, and tourism makes it particularly sensitive to economic downturns. When energy prices slump or tourism slows, Louisiana's job market and tax revenues take a direct hit. Housing is another looming crisis. Louisiana has some of the nation's oldest housing stock, much of it in flood-prone areas, which drives up insurance costs and makes affordable housing even harder to find. Median household income is just over $55,000, well below the national average, leaving many families with little margin for error. Natural disasters compound Louisiana's economic fragility. From hurricanes to coastal erosion, the state faces billions in recovery costs every few years, draining public coffers and straining services. A recession would hit an already stretched state budget, forcing painful cuts to education, healthcare, and public safety. Without stronger fiscal planning and economic diversification, Louisiana risks facing a perfect storm of economic collapse. If the national economy crashes, Louisiana is poised to fall first and hardest. Here are 5 practical tips to consider. If you live in a U.S. state at high risk during an economic crash, diversify your income streams. Relying on a single job or industry in a vulnerable state can be risky, so explore side hustles or remote work options to stay financially afloat. Build an emergency fund. Save at least 3 to 6 months' worth of living expenses to cushion against layoffs, rising costs, or sudden economic disruptions. Reduce debt and unnecessary expenses. Pay down high-interest debt and cut back on non-essential spending to increase your financial resilience. No local assistance programs. Familiarize yourself with state and local support resources, such as unemployment benefits, food aid, or housing assistance, before you actually need them. Consider relocation or backup plans. If your state's economy is heavily reliant on vulnerable sectors, research more stable areas and have a relocation plan in place if needed. There you have it. 10 U.S. states walking the edge of collapse if the economy crashes. From fragile pension systems to environmental disasters, these states reveal just how uneven America's economic resilience really is. When the next downturn hits, it won't strike equally. Some places will crumble long before others. If this opened your eyes, make sure to hit that subscribe button, like this video, and share it with anyone living in one of these high-risk states. We'll keep bringing you the facts and insights the headlines miss, because being informed isn't just power, it's survival. Stay tuned, and we'll see you in the next one.